So I'm Adrian Leeds, and I am the co-sponsor of this event, which is the North American Expats in France Quarterly Financial Forum for the first quarter. We have with us Brian Dunhill, who's the co-sponsor with Dunhill Financial. There's Brian, yeah, and you'll see Patty Sadowskis. She's our assistant. She's going to be working with you guys to ensure that you put all your questions in the chat and we get all the questions, as many as we can, answered. So please do that along the way. And we are very pleased to have Jonathan Hadida with us with Hadida Tax Advisors. He was the founder of that. He's going to be talking today about your tax issues as a US, not Canadian, not North American, but this seminar is basically for US and French tax returns for US persons who are living in and around France. So welcome everyone to our webinar. And let me just give you a couple ideas. We're going to be recording this, and so you'll be able to watch this or share this with your friends later. And a link to that recording will be sent out to you by email after the event. You'll probably have it by sometime tomorrow. And before we begin, I just want to let you know that the next one of these will be June 7th at the same time, 7 p.m. France time. So mark it on your calendar. And a link for that will be advertised on our website, adrianleeds.com, as well as on dunhillfinancial.com. And so now I'm going to turn over this session to Jonathan Hadida, who will speak for about 30 to 40 minutes. He has a PowerPoint presentation, and then we'll open it up to a Q&A. Please keep your questions to general, not too personal or specific. Put them in the chat. Patty will then monitor them, and we'll answer as many as we can. So on that note, Mr. Hadida.
Excellent. Thank you, Adrian. Well, thank you all very much for joining us this evening. It's a great pleasure. I'm always excited to talk to Adrian and Brian in any circumstances, but especially in these circumstances, because the start of the tax year is always a fun time for everybody. No stress, no hustle, no fuss. It's easy peasy Japanesey. At least that's what we try and make it out to be. So today we are going to talk about taxes. So
I have never known anyone as enthusiastic about tax as you, Jonathan.
Adrian, you have to be excited about taxes. It all comes back to taxes. Everything comes back to taxes at the end. So that is why I am so excited to be talking to you all today. So today we are talking of a 2023 tax update. So, let me go quickly to what we're going to talk about. We are going to talk about an overview of the U.S. tax implications for U.S. individuals living in and around France. So it's important that you as a U.S. person know what your obligations are, both in France and in the U.S. So we'll spend time on that. We will talk about the bee's knees of treaties, the U.S. and French tax treaty. We're going to talk about the tax deadlines, so dates you need to know, certain legislative changes that have happened in 2022 that will impact U.S. individuals, again, living in France. We're then going to talk about how you can retire in France and still have that boat. So we're going to talk about investing while abroad. And then last but not least, we are going to touch on a question that a lot of clients ask us all the time is basically, hey, I've bought this magnificent property with Adrian Leeds Group. It has gone up in value so much, I need to sell it now because I need to buy a chateau, and Adrian is helping me buy a chateau in the south of France. Can you please help me with the tax implications of selling a real estate in France? Okay, so
Please don't buy a chateau. Please don't buy a chateau in France if you can help it. Okay.
Sorry, don't buy a chateau. Buy a house in Nice. Buy an apartment in Nice, or maybe.
I got it. Exactly.
There you
never
go.
saw the money pit there, Jonathan?
Sorry?
You never saw the money pit?
No, I didn't see the money pit, but I did see House Hunters International, and there was a nice couple from Boston on it. And let me tell you something, Adrian found them the right place for them. So, anywho. So, give you all a little background in terms of myself. My name is Jonathan Hadida. I am the founder and CEO of Hadida Tax Advisors. We are a US and French tax firm helping US individuals living in and around France. So I'm a member of the New York Bar. I also have a variety of law degrees. I basically didn't want to start working, so I just kept on going to school. Prior to starting Hadida Tax Advisors, I worked for various firms in France, Switzerland, Belgium, and the US, as well as for the Canadian government. So basically, I've got a little bit of gray hair, try and stay young by doing these kind of things and enjoying taxes, but we've done a little bit. So let's get started. Now, before we do get started, on behalf of me and my entire team, I would like to wish everybody a happy International Women's Day, especially you, Adrian.
Yay!
So, happy International Women's Day to everybody. I hope you have a great day. And with that, let's keep the good times rolling and start with taxes. So, U.S. taxes for individuals living abroad. So, it's a refresher for those of you who've been abroad. For those who may be coming out here, cool. Let's tell you what your obligations are going to be. So, who is a U.S. tax resident? A U.S. tax resident are U.S. citizens, green card holders, or individuals living in the U.S. and meeting something called the substantial presence test. For our purposes today, the two that really matter for us are citizens and green card holders. Okay. So if you were born to U.S. parents and have a U.S. citizenship, if you were born in the U.S., like my nice little son, Eric, a 5-year-old blonde-haired little boy, he is a U.S. citizen and you have a U.S. tax filing requirement. So it's important that you understand that irrespective of where you live, you are required to file a U.S. tax return. Now, what goes on your U.S. tax return? U.S. tax residents are taxed on a worldwide basis, irrespective of where you live. Therefore, you're required to file a U.S. tax return, report your worldwide income. So you work at McDonald's in France, that money gets reported to the French government, to the U.S. government. You work at ExxonMobil in France, you report that income to the U.S. government. Okay, so again, U.S. tax residents, citizens, green card holders are taxed on a worldwide basis. So now you're sitting there saying, well, shoot, Jonathan, I'm paying all this tax in France. How am I going to avoid double tax? Well, it's quite simple. The U.S. government gives two mechanisms to avoid double tax. And we're going to touch on these now. We're also going to come back to them a little bit more in detail when we talk about investing, because these have an impact on IRA contributions. Go figure. So the first is the foreign tax credit. Okay. The foreign tax credit is a credit for the French taxes you pay or accrue in the year, okay? And that means your income tax, and here's the kicker. From a U.S. perspective, you also have certain social charges, CSG, CRDS. Your CSG, CRDS charges are also creditable as U.S. income taxes. So therefore, a U.S. person living in France and working in France, you can benefit from a foreign tax credit for your French taxes paid or accrued, as well as your CSG, CRDS. So using those two mechanisms, for the most part, you should be able to offset all your U.S. tax implications on your earned income, or potentially even your investment income. But we'll talk about investment income later.
Well, especially since the French tax basis is higher than
It
US.
is higher, yes, ma'am.
Right?
The French taxes is significantly higher. You know, it's up to 45%. The CSG CRDS is 9.7%, Adrian. So, but the nice part is 9.7% of all the social charges you're paying to France. Again, if you pay 20% of social charges, 9.7 of them, so about 50% of them may be deductible are deductible on the US side. So again, this is a way to ensure that you don't pay double tax on the US side. So it's important to understand, filing a tax return, you probably won't owe any taxes to America, at least on your French sourced income. Again, if you have nice investment income, you have great rental income, you may wind up paying taxes on that, but on your earned income in France, you will not pay double tax. Okay. So there's the foreign tax credit, which we just touched on. The other one is something called the foreign earned income exclusion and the foreign housing exclusion. Well, what are those? Those are basically an exclusion that allow you to write off straight off the top, take a straight deduction, an exclusion or deduction straight off the top of $112,000 earned income, $112,000 of earned income. So if you work in France, you work for a company, you make €112,000 $112,000 under the exchange rate a few months ago, you will be able to exclude all of it straight off the top, no fuss, easy peasy. So these are the two ways that we help you avoid double tax. And again, we're going to touch on the interplay between these two later, but it's important to understand that you can use either or. Now, once you've taken the foreign earned income exclusion, you can change and vacillate back to the foreign tax credit, but you can only do that once every 5 years. So if you're on the foreign earned income exclusion and you then change to foreign tax credit, you're kind of stuck for 5 years. Again, we'll come back to that when we talk with Brian about investing in France. So from there, what other considerations should an American living in France be cognizant of? The main ones are the foreign bank account reports. Okay, the foreign bank account reports are quite simply put, the US government wants to know what bank accounts you have in France. Okay, in France or outside of the US. So there are two. There's the FBAR and then there's the Form 8938. What is the FBAR? The FBAR is the Foreign Bank Account Report. The Foreign Bank Account Report is required to be filed provided that you have over $10,000 in foreign bank accounts cumulatively at any point in the year. So what that means is you can have 5 bank accounts with $2,001 in it. Well, that's over $10,000 cumulatively. And again, it's at any point in the year. So again, I've had a lot of clients come to me and say, hey, Jonathan, I bought a house with Adrian and Nice. I transferred the money to my French bank account, and we're going to talk about that after. Adrian has specifically wants to talk about how to transfer money in and out of France to buy properties, but transferred money to a French bank account, transferred it to the notaire 5 minutes later, that is enough to have an FBAR requirement. Okay, so it's important that you as US peoples or tax residents understand that that is a requirement you will have going forward. Okay, now you'll see below there the Bittner case, a US Supreme Court decision of February 2023. So I assume you guys are not like Adrian and Brian and myself, because I can tell you, Adrian was in Hawaii. She was sitting on the beach and she did not hear of this. She did not.
No, you're right. I don't know anything about it.
She did not get overly excited. But I can tell you, I got plenty excited when this case came out. This case has clarified that the penalties for not filing FBARs are now per form. So what's that mean? That means if you haven't filed your FBARs for the last couple of years and have not gone into the streamlined tax filing program, which again is outside the scope of this, but if you have not filed, please reach out. There are ways to get into the US government's good graces, and we can help you with that, be it us, be it another firm, but getting into the US government's good graces is highly recommended.
Jonathan, what was the decision?
Oh, I'm coming, Adrian. Give me a second to tell my spiel. My spiel about the streamlines. So the Bittner decision. The Bittner decision was a gentleman who had a shed load of bank accounts outside of the United States. He never declared them to the United States government. They hit him with over $2 million of penalties for not filing these FBARs. So as you can imagine, Mr. Bittner was not a happy character. He went all the way to the Supreme Court and he won. And now the penalty is no longer per bank account, because I have a client who's coming into compliance. She has some bank accounts at NatWest in the UK. They have £5 in them. Well, up until Bittner, I was telling her the penalties may be up to $10,000 per account you have at NatWest. It's now up to $10,000 per form. So that's a big win for US expats living abroad and US taxpayers in general. So the Bittner case, that's why I put it here. You know, we don't usually talk about US Supreme Court cases on these forums, but this one here was so big that I just wanted to share with y'all. As I said, Adrian was in Hawaii. She didn't hear about it, but I'm sure it would have made her vacation that much more exciting.
But Jonathan,
wait,
Jonathan.
Yes, ma'am.
Go ahead, Adrian.
No, I was just going to say that the questions I get on this, which I know are going to hit you up in a minute, is people are worried that because they're reporting the bank accounts that they're going to owe taxes on the money in those accounts.
No, this is a reporting requirement. It is not an income tax filing requirement. It's more of a money laundering avoidance thing.
Right.
It is not an income tax thing. It is not the US government who is searching to see if you have $1 or $1 million in a bank account. They simply just want to ensure that your income is reported and you're not laundering money illegally.
Right.
Brian,
They
you
do
have a
the same
question?
thing in France, by the way.
Yes, they do. And
In France, you have to report your foreign accounts as well.
exactly. And in France, the difference between France and the US wants to know more. The US wants to know your maximum balance in the year. France simply just wants to know what bank accounts you have. So again, it's a reporting requirement. You have to do it. There's no big issue to do it. There's not a boogeyman hanging around the corner, at least as far as I can tell. I've been doing this 17 years. Boogeyman hasn't come gotten me or my clients yet. Thank goodness. Of
No,
course,
I never saw Boogeyman either.
no
But I
good.
have one other stupid little question, and that is that, of course, trying to determine what the highest amount is during the year is the biggest pain in the butt ever. Okay. Because otherwise you just get your statements and you see the bottom line statement, but it's not the same thing.
No, you have to look at the maximum balance in the year. So you have to flip through your bank account statements, go online, go through the statements, go one by one. Again, if you cannot find the maximum balance, or you have to give as close as possible, but it's technically
Right.
you should be giving the maximum balance. Again, if you can't find your statements, but you know that in September you bought a house in the south of France with Adrian Leeds Group, then cool. Get us the maximum balance in that month at the very least. Okay. Brian, you also had a question.
I was going to say kudos to you for actually finding a Supreme Court case that's nonpartisan on that. You know,
This was totally nonpartisan.
exactly. That's why I'm giving you kudos for that. You know,
Yes, no, this was an incredible case that left, right, doesn't really matter. Everyone came together on this one.
now, a couple things just to make sure that you clarify it for everybody. This includes all corporate and charitable accounts that you might be a signer for, correct?
Yes, it includes all accounts that you have signatory authority over.
Perfect. So that's an important one right there. Now, some of the ones that I'd love to hear your general thoughts on. If somebody has, say, a TransferWise account with a balance on it, that's a UK company that has a US subsidiary, do they have to report it?
I would.
Perfect.
I would.
Better to be safe than sorry.
Yes, ma'am. That's
would
right.
be my motto.
And the last one that I'm going to cut out this clip and just send it to every person that asked me a question about an FBAR. Their foreign pensions, should they declare them or not on their FBAR?
Yes. Yeah, I would. And then the foreign pensions also get reported on Form 8938. So I generally would report them. Yeah.
Perfect.
Okay.
And
I'm going to have a question about Form 8938, and I don't know if you're going to address this at any
I
point,
was
because
not. I was going to skip 8938, but I don't see.
let's save it till the end.
So 8938 is basically something similar to the FBAR. It's a very similar form in that you have to still report. It's now on. This is now on the tax return. The 8938 is a form on your tax return whereby you have to report your bank accounts to the IRS, because the FBAR is to the Department of Treasury. The 8938 is to the IRS. The 8938 though has different minimum balances in order to file. So in order to file the 8938, you have to meet certain thresholds. Of a taxpayer living abroad, it's generally between 400 and 600,000 for joint filers, 200 and 300, and I apologize if I'm getting this wrong, doing this from memory, 200 and 300 for single filers. So again, depending on your filing status and depending on how much money you have in the year, either at the end of the year or as a maximum balance in the year, you may have an 8938 filing requirement as well.
Okay, when we're on our Q&A, I'm going to ask you a little more detail on that, okay?
Sure, and I will quickly rush to pull up the numbers on my screen so I don't make a mistake on this, but it's generally, it depends. If you're in the US, the thresholds are lower. If you're outside the US, the thresholds are higher. Okay. The other thing that I did not put in these slides, but I do want to just let people know, if you receive a gift from a non-resident person, so for example, if If Brian receives a gift from his neighbor, who's a non-US person, over $100,000, and trust me, having Brian as a neighbor, that just in and of itself is probably a gift. But if Brian receives a gift from his neighbor of over $100,000, there is a foreign gift filing requirement that needs to be done. So that's also something just to be aware of, is if a family member who's a non-US person living abroad gives you a gift of over $100,000, there may be or will be a filing requirement with the IRS. So that's just something that we just want to share, because again, it's something that most Americans may make that mistake. Now, the French-US tax treaty, okay? The bee's knees for American retirees, okay? I workshopped that one, so just letting you all know, it truly is a magnificent tax treaty. This tax treaty is such that I have jumped up and down and told American people that moving to France is, you will pay as much tax in France as if you moved to Florida. So you can move, instead of moving to Florida and dealing with the heat and the humidity and the swamps, come to France, come to the south of France. I think go to Hérault, but Adrian's about to kill me now, so I'm going to stop talking about Hérault. Come to the south of France, move here, because the tax treaty is such a magnificent tool to avoid double taxation. And it's such a magnificent tool that you basically will not pay more taxes than if you move to Florida. And the reason for that is in Florida, you only pay federal taxes. Moving to France, you technically will generally only pay federal US taxes also. Why is that? The US-French tax treaty states that for US citizens living in France, US sourced interest, dividends, capital gains, pensions, rental income are all taxed only in America. What's that mean? That means that you still need to report them on your French tax return. So on your French tax return, you still have to tell the French government, hey, I have $100 of interest income. Or if you're like me who invests $1,001 a month at Dunhill Financial, I have $100 of interest income every year. Well, my $100 of interest income from Dunhill Financial as a US citizen, well, that goes onto my tax return. And then we calculate the tax. So the tax in France is 30%. France then gives a deemed credit equal to the French tax. So you wind up paying no French tax on this income. So basically, your French tax return will show all your investment income, all your US pensions. With a deemed credit, you'll wind up paying as much tax as I'm holding in my hands, as much tax as the money I'm holding in my hands right now. Okay. So you will not wind up paying any French tax on it. So again, the bee's knees for American retirees.
But they'll pay it in US. They'll pay the tax
in the US, Adrian,
in the US.
They'll pay it in the US if they stay in the US. They'll pay it in the US if they come across. So
That's right.
Coming to France, again, people are scared of moving to France because of the high taxes. Unfortunately, there are high taxes on workers. But for retirees, especially specifically for American retirees, this is magnificent. Okay. Any questions, Adrian?
So for any of you that don't know what bee's knees is, don't Google it because you're just going to get a drink menu, which I just did. It's really the best. But now this cocktail does sound pretty good, especially with Jonathan as the entertainment, because it's thin, fresh lemon juice and honey. And that's how you make bee's knees. A nice Hemingway cocktail for you for when you're in Paris next.
There you go. Well, talking about that, Brian, thank you for pointing that out. Next week, Tuesday, 3 o'clock, Adrian Leeds après-midi. Be there or be square.
That's right. 3 to 5 p.m. at Le Café de la Mairie. Jonathan's going to be speaking.
Yes. And
can I get a bee's knees cocktail?
Sure. So, 2022 tax filing season, the key dates and information that you as a US person living in and around France need to know. So, first, from a US perspective. From a US perspective, the filing deadline this year is April 15th, the initial filing deadline. Now, as US persons living in France, you benefit from an automatic 2-month extension through till June 15th. From there, we can request an additional extension until October 16th. Now, generally, as a guiding rule, as a US person who works in France, you more likely than not will need to file an extension until October 16th. So be prepared to file an extension. You may say, why is that, Jonathan? It's because you're too lazy to get work done. It's not that we're lazy. It's not that we're sitting around twiddling our fingers right now. It's that we need to have your French tax assessment in order to have your foreign tax credit number. So we technically, and we're going to talk about the French deadlines in a second, we need to wait for you to have your French assessment. So you more likely than not will need to file an extension through till October 16th. Okay?
Jonathan,
Yes,
for
ma'am.
those of us living in France who have to turn in the French tax return in May,
Yes.
okay, we still have to make some sort of a decent guess
Yes.
on our
by
US
April
return
15th.
in order to turn it in on the French side. It's my annual conundrum.
Yeah. No, it definitely is. It's a, and Adrian, not to be too pushy of a salesman, that's why firms like mine exist, because we do both returns. Sorry, I do.
Exactly.
But basically, you are absolutely correct. And one other thing is, if you're going to owe to the US government by April 15th, it's better to make an extension payment now to avoid additional interest and penalties. So again, as much as possible, we recommend that you make a payment by April 15th or April 18th this year. Okay. Now, one thing that Americans who come across and are new to France may not know is that October 5th, 16th, if you're not able to file your tax return by October 16th, we can still file an additional 2-month extension through till December 15th in order to make sure that you have enough time to file your return. Okay. Now, the main thing to be careful of with the December 15th deadline is that November deadline. In the middle of November, on some random day, the IRS will close electronic filing. Now, why does that matter? It matters because the processing of tax returns is far, far slower when you paper file, when you mail it in, be it the Postal Service, be it the IRS. It's just better as much as possible to electronically file. So as much as you can, I highly, highly recommend that y'all file your returns by mid-November at the latest. Now, we touched on the French deadlines before just a second ago. So the French deadlines are very important from an American perspective to understand. Mid-April is when the tax season opens. This year, it should open around the beginning, the 8th or the 9th, but again, mid-April. Now, that's when the forms come out. I cannot finalize a French tax return today because I do not have the French tax forms. So by mid-April, the French forms will come out. By mid-May, if you're new to France, that is your filing deadline. The filing deadline for first-year filers and first-year, final year, and non-residents is mid-May. The deadline for everyone else is beginning of June. So the French tax season should be looked at as a very big sprint. We have about 6 weeks to get your returns done. So it is imperative that you understand that we need your information as soon as possible because you've got until mid-June to get it. So the return's done mid-June. What happens? You send in your tax return, you're done for your role. But by mid-September, by September-ish, the important word is the ish, because it could be sooner, it could be later. By September-ish, the French authorities will send you an avis d'impôt, the tax bill, saying you owe money or you get a refund, okay? That is why it is important for you to generally file an extension until October. We need to have that avis d'impôt in most cases to ensure that we get the right number for your foreign tax credit. So you'll get your avis d'impôt September-ish, and at that point, if you owe money, so for example, let's say you owe €1,000, that €1,000 will be split out in 2, 3, or 4 periods, in monthly installments. Again, the French government will put this all in your tax bill. Okay, so that's the deadline. So again, mid-April to make a payment, June to file an extension, October to get the return hopefully done. Worst case scenario, you can always file an extension until December. But again, as much as possible, I highly, highly recommend from a US perspective that you get your return done by mid-November, if you can. Okay. Legislative changes that may impact you as expats. Okay. The first one is the Secure Act 2.0. The first two are American, the last one's a French one. The Secure Act 2.0, and I promised Adrian we would use as many acronyms as possible in this training session. So required minimum distributions, RMDs. Required minimum distributions are the minimum distribution that you need to take out of your IRA. Okay, the age has increased to start taking minimum distributions in 2023 from 72 to 73. Therefore, if you were born after January 1st, 1951, you now have an extra year to start taking these distributions from your IRA. Additionally, if you were born after January 1st, 1960, you now can wait until 75 to start taking your required minimum distributions. Again, a small change, but still something to factor into your planning when you have consultations with your financial advisor. You speak to Anya at Dunhill Financial, you need to just add that into your thinking. I now have an extra year before I have to start taking my RMDs, my required minimum distributions. Additionally, the Secure Act has done another big change. They have changed it with regards to 529 plans. It used to be that if you were not able to use your 529 plan for educational purposes, and again, as Americans living outside of the US, we understand that our kids may fall in love and want to go live la vie bohème sur la Pont des Amours à Paris. But if that happens and we have money in their 529 plan, we can now roll that money can now be rolled over to a Roth IRA, okay, within certain provisos. So starting in 2024, beneficiaries, so the children of whoever's the beneficiary of a 529 plan can roll up to $35,000 to a Roth IRA, okay, provided that the 529 plan was in place for 15 years. But that's a huge victory for Americans, again, because of the fact that our kids may not want to go to university. They may hopefully get a scholarship. They may decide that Paris Panthéon-Assas is where they want to go to school, which is a fantastic school. And Adrian will be happy to show you rental apartments near there. But basically, this is a big, big victory for Americans, especially for the children, to have more flexibility. Because again, if they can't use it for their school, we might as well give it to them for their retirement. The next one is only for folks who own property in France. And this is a big one. So you may or may not be aware that France has done away with the taxe d'habitation pour une résidence principale. So it's gone the way of the dodo bird. If you use your home as a principal residence, you no longer have to pay the habitation tax. Hooray! But
Except the other taxes are going up.
Yes, ma'am. That's the issue.
To compensate for it.
They've got to pay for a lot of stuff in France. So now what the French government have done in order to ensure that they know what properties are being used for what purposes, they've introduced a déclaration d'occupation et de loyer. Basically, you now have to tell the French authorities, I own a property on 123 State Street in Paris, and it is used as my principal residence. It is used as a secondary residence. It's vacant. It's occupied for free by my friends, or I've rented it out. Okay. For now, it's a simple declaration that you have to simply tell the authorities, this is what I'm using the property for. Okay. This declaration must be done by June 30th. So for our clients, we are in the process. We've sent out all our organizers and our questionnaires. Every single client that we have that owns a property, we're going to ask them, do you need help? But if you need help, please let us know. Reach out to us, reach out to Adrian, reach out to Patty. We have this information. We can help you, give you the guidance on how to get it done. Because again, why pay a 150 euro penalty if it's simply going into your impôt.gouv, which is your online French tax authorities website, to declare how you're using your property. Okay. So with that said, we are now going to touch on the section that I like to call how to buy yourself a boat living in France. So it's investing in France as a US expat from a tax perspective. So now Brian's going to get off his drinking his bee's knees and he's going to come in and join me a little bit. But we're going to talk about a big one from US individuals. And this is one that I spoke today to a great couple who've just moved here from Cameroon. And we're going to ask, I've got a question from them for Brian. So PFIX, what is a PFIC? Let me tell y'all what a PFIC is. A PFIC is the thing that gives Brian a job. Too blunt, Brian?
One way of putting it.
One way of putting it. Charm also give you a job.
I was thinking that it's a 4-letter word, and so we try to avoid it, just like all other 4-letter words.
There you go.
So, essentially, the main PFIC that you're going to stumble upon and you're going to hear people talking about constantly in France are going to be assurance vie, right? Now, PFICs can be a variety of different things. It could be that you just have a foreign company that has the majority of its income coming from passive income. But anything that looks like a mutual fund or even an exchange traded fund that's traded in a foreign jurisdiction other than America will be considered a PFIC, a passive foreign investment company. Now, the main reasons why we always suggest avoiding any of these PFICs is because, first of all, you're going to end up paying more in taxes. Second of all, you're going to have annual filing fees. And third of all, I've actually never seen one of these investments that we can't replicate something in the United States for cheaper, less taxes, and less filing requirements. We've got to remember 58% of the world's companies on market cap are actually listed in America. And so therefore, every single exchange traded fund or mutual fund strategy is already represented over there. So don't let yourself be convinced otherwise, because otherwise you're going to spend a lot of time with Jonathan. I'd rather be drinking bee's knees with Jonathan than sitting there doing PFIC filings with him. Now, the one that you're going to hear constantly is this assurance vie. Now, assurance vie, for those of you that don't speak French, is life insurance. Now, just like in America, we've kind of got it backwards in certain ways. So think of the equivalent of a variable annuity. Essentially, you own a vehicle that has a little bit better estate tax components in France. Now, the problem is everything that you would own in there would end up becoming a PFIC. So I've never found a situation that would merit an American buying an assurance vie policy. And I caught Jonathan off guard the last time we presented by saying, I finally found a situation where I would recommend an assurance vie for an American. And it's if you call me up and you have less than 6 months to live, you know you're only trying to avoid estate tax in France and you're not going to invest anything. You're just going to put it into a cash vehicle in the assurance vie. So unless you're going to die in 6 months and you know that, please don't fall into that trap of getting the nightmare of PFICs, because it's going to cost you more, you're going to pay more in taxes, and you're going to have a lot more tax to actually deal with.
Sorry, Brian. So I have a quick question. So Gael, who I spoke to this afternoon, asked me, I'm a French individual. I want to invest in French companies because at the end of the day, I want to support my country's economy. So if we have individuals who are living in France and want to be patriotic and want to invest in French companies, how would you do it? Or want to invest in a broad base of French companies?
Absolutely. So essentially, all we want to do is either buy individual companies, or if we're buying a collective, we want to buy it on the New York Stock Exchange or on a US stock exchange. So for instance, we can buy an ETF of the CAC 40, so the 40 biggest companies in France, on the New York Stock Exchange. But we can also buy most every French company and get it listed on a 1099 statement in the US. We just don't want to buy a managed fund in France. Now, the good news is most of the managed funds in France are not actually managed very well, so it's not going to be very competitive and you're not going to lose out on anything. But we can buy those individual companies with no problem in a US-based brokerage account. And then Jonathan will get a 1099 and he'll be happy.
Yeah. Cool. All right, let's talk about IRA contributions. Because again, it's IRA season and we want to maximize your retirement, even if you live in France. So IRA contribution limits for 2022, $6,000 with a catch-up of $1,000 for individuals over 50. For 2023, $6,500 with a catch-up of $1,000. So basically, again, good to know your limits. If you're over 50, it's $7,000. Under 50, $6,000 for this year. You have until the deadline. And then for next year, it's $7,500 or $6,500. Okay. Now, I did promise to come back to the foreign earned income exclusion and foreign tax credit discussion.
Can I pause you on that first?
Absolutely, Brian.
I'm going to just sound like a used car salesman saying, if you call me between now and April 15th, we can do both last year and this year. That is why Jonathan's bringing up both of the limits. You can do 2022 contributions all the way up until April 15th of 2023. So an operator standing by to take your call right away.
Perfect. So, yeah. So in terms of this, it is important to understand, and this is what I touched on it earlier, and I said I was going to come back to it. Foreign earned income exclusion versus the foreign tax credit. High level. The foreign earned income exclusion, as I said earlier, allows you to exclude straight off the top up to $112,000 of taxes of income in 2022 and $120,000 in 2023. Well, what that means is you may not wind up having any taxable income. And as Brian will tell you, and he hits his head on his desk every time he sees it, if you don't have taxable income, you cannot contribute to an IRA, and you can't help Brian. You can't have Brian help you to do that. So the foreign earned income exclusion versus foreign tax credit question is one that we see all the time. So when you're moving to France, it's something that we want to look at and see what is best for you. Is it better to do the foreign tax credit, or are we better served taking the foreign earned income exclusion? And if we take the foreign earned income exclusion, you may or may not be able to take an IRA contribution. So a conversation needs to be had generally in the first year when you come across, or in subsequent years. Have a conversation and say, okay, I'm going to be in France for the next 5 years. I'm going to be taxed heavily in France, so a foreign tax credit should be enough, and I'd like to put money into my IRA. So then we go down the road of the foreign tax credit. The issue, as I said earlier, the issue with the foreign earned income exclusion, it's not a problem. It excludes all your money. It excludes all your income. You don't have any taxable income. But if you don't have taxable income, you can't contribute to an IRA. And if you want to go to the foreign tax credit, you can't come back for 5 years. So again, folks who live in France, I would not recommend y'all leaving. But if you move to France and decide, I don't like it here, enough with these with the people wearing the red berets walking down the street and holding their baguettes, we want to move to Dubai because Dubai is better. Well, in Dubai, you need to take the foreign earned income exclusion. So again, this is proper planning needs to be done up front. Okay, so that's again, foreign earned income exclusion, foreign tax credit. Have a conversation with your tax preparer, especially right when you're coming to France, or even if you've been here for a while, to see what's right for you and how you can maximize your IRA contributions in the future. Last one is Roth conversions. And I am a huge, huge fan of Roth conversions. And the reason I'm a huge fan of Roth conversions is because I know that time value of money, and that basically if you put $1 in today with compound interest and with proper planning and with the help of the team at Dunhill Financial, that dollar will certainly be worth more upon retirement. So why do I talk about that from Roth conversion perspective? I talk about that from a Roth conversion perspective because a Roth conversion allows you to crystallize your taxes now. So if you have $100,000 in an IRA, okay, and you want to roll it to a Roth because you're 35 years old, well, you can roll it to a Roth. You will pay tax now. So you will get a little bit of paying today. But again, 35 years old, 24 years down the road, 100,000. Brian, easy peasy question. $100,000 invested with you now, 24 years down the road, 5 million, 10 million, 20 million. Sound about right?
Rule of 72 would basically say that you would double it twice over. So we'd be sitting there looking at about, what, 480,000 on 100,000.
So cool. So basically we have $380,000 a gain there. Well, we've crystallized our tax today. That $380,000 of gain over the next 24 years, guess what? That's tax-free. That's tax-free. That's money that you will get upon retirement without having to pay taxes in America. And if you live in France, with the treaty, no taxes in France either. So again, a Roth conversion is something you'll want to look at and see if that makes sense for you now. Again, if you're at a lower tax bracket, taking that hit now will make sense. There's also something called a backdoor Roth, whereby you contribute to an IRA in the year. So for example, I saw that today with one of my staff. The client contributed $7,000 because they're over 50 to an IRA. They then took a non-deductible IRA contribution. So they didn't take a deduction and they immediately rolled it into a Roth. So that's called a backdoor Roth. Well, what's the tax implications? The tax implications are that they put money into an IRA because they weren't able to put into a Roth because of spending of income limits. They put money into an IRA and immediately rolled it over. And now that money is going to grow tax-free until their retirement. Okay. So again, Roth conversions are something to pick up the phones. The operators at Dunhill Financial are standing by. They are more than happy to help you all with that. But it's a great tool, especially if there's a market downturn, and hopefully there's not a huge market downturn, but if there is, when the money goes down, it will come back up. So again, we want to make those Roth conversions, or at least think about it and talk and make some proper planning on these Roth conversions as we go across. All right.
Just really quick, because I love having Jonathan around because he answers these big questions. So you get this foreign tax credit, right?
Yes, sir.
Now, we don't only have retirement accounts on the US side. Some of the people working on the French side might end up having some French retirement accounts.
Yes.
Now, you see how Jonathan's bowing his head down kind of in shame that, I'm going to bring it up. I'm going to bring it up. These are taxed horrendously, but the foreign tax credit could help out on that, correct?
Yes. So the foreign tax credit, and this, Brian, to be honest with you, is a tool more used in Belgium and Netherlands, because in Belgium and Netherlands, we want to build up. But basically, if you're about to go into retirement, we want to build up as much as possible of foreign tax credit carryovers as possible, so that you can use them to offset income that's either taxed horrendously in France or not taxed at all in France. So we want to make sure, again, proper planning. The name of the game is plan ahead, pick up the phones, operator send all that fun stuff, but no joke. It's doing proper planning up front, especially, again, in the case of retirement. In the case that, because in France, there are laws with regards to when they fire you or when you leave a company, you get an indemnité, the indemnities. All these things have to be properly planned from a US side and a French side. So again, talking to your advisor is key. It doesn't matter who it is, talk to your advisor and get as much help as possible. Anything else, Brian?
No, that's perfect.
All right.
I know we've got a couple of those questions already in the Q&A, so I figured it was the good time to bring them up.
Okay, cool. Sorry, I'm focusing on the slides and sharing.
You should.
So, sale of real estate in France. Okay, because this is a question that Adrian and I get all the time. I can tell you, just last week, I was walking down the street and someone didn't ask me this question, but I was thinking that someone would. So I wanted to be prepared in case someone did ask me this question. When you sell a property in France, how is it taxed? Because this is a question, again, we do get this question often. How is it taxed? France has specific tax rules around the sale of a principal residence, of a property. The questions that we have to look at are, how do you use the residence? Is it your principal residence? If it is a principal residence and you've used it as a principal residence for longer than 1 year, because again, that's the time that it crystallizes for the tax authorities that it's a principal residence, you don't have to pay tax on the capital gains on your sale. If it's
Jonathan, I often get the question
Yes,
from
ma'am.
people who say, I am not resident in France, but the property in France that I own there is my only property in France. Does that make it my principal residence?
no.
Of course not. Okay, just answering the question before
Yeah.
we get it.
Exactly. So there you go. But no, it's not, unfortunately. You'd have to live in the property. So if you live in the property, you don't have capital gains. The second question is, how long have you held the property? Because France gives an exclusion, an exoneration, and it's a rateable exoneration. And Patty will put something into the chat, if that's okay, Patty, if you don't mind. There's a site where y'all can see the exonerations, but basically, long story short, there are two types of taxes on the sale of property: income tax, social taxes, social charges. The income tax is fully exonerated over 22 years. So that 19% income tax, after 22 years, full exoneration. The social charges, 17.2%, only over 30 years will they be exonerated. So the longer you hold the property, the more your exoneration will be, the less your tax will be. Okay, so if you held it for less than 6 years, you're looking at a 36.2% capital gains tax on the sale of your property. If you've held it for over 30 years, you will not pay capital gains tax in France. Okay, now one main thing to take note of, and we'll talk about it here, is what are the US implications of this? Okay, the US implications are that if you sell a house in France, and as an American person, American taxpayer, you will pay tax in America on it. It has to be reported to America. So you'll get, again, a foreign tax credit for any taxes paid to France. But it's very important you be careful of a mismatch in taxation. So again, if you've held it for 30 years and don't pay tax in France, well, unfortunately, Uncle Sam is still going to tax you on that capital gain that you've built up over the last 30 years. So you need to just take note that, unfortunately, as an American person, you can't get away from the American taxes. Okay. Adrian, do you see that with your clients?
Well, I want to make a note about the Social Security contribution, because the EU basically believes, the EU, not France, the EU believes that the Social Security contribution that is made by non-residents who don't live in France and don't benefit from the Social Security taxes shouldn't be taxed on it, but France continues to do it. Now, the thing is that you can make a claim, you can file a claim to get your money back, but I don't know anyone that's ever gotten their money back. So France basically said, screw you, EU. Okay, we don't care what you think. We're going to assess this tax anyway, and everyone has to battle for it, and that's kind of the way it works. Just so you know.
And one other big thing from a U.S. perspective to understand on when you sell a property in France, it all goes through the notaire. The notaire is the one who will handle your taxes on this sale. Okay, so it's important to understand it's not done like in the US on your US individual on your French individual tax return. It's done via the notaire.
Well,
and that's an important one.
It's done at the time of the sale. It's extracted at the time of the sale. But by law, you have to hire a tax assessor in order to determine the amount of tax you're paying, which costs you some money. So you have to hire the assessor. That costs you some money. And there are some exclusions. You know, if you've done certain kinds of work on the property, you can actually exclude that from the capital gains tax. But you have to document everything, and it's very difficult to prove that the work were home improvements. So let's say you added a bathroom, that would count. But if you just redecorated the bathroom, it doesn't count. But there is a 15% automatic exclusion that's just across the board, assuming that you've done you've made some improvements to the property.
Now, Adrian, the other question that my clients ask me all the time, and I'm certain you're better to help them with than I am, is transferring money to and from France. So when clients buy a property in France or when they sell a property in France, what do you recommend clients do?
Well, the money should never go into their French bank account before going to the notaire. The money needs to come directly from the account in the name of the buyer. Okay, and it had that there's an attestation to prove that from the bank, and it goes directly to the notaire. You don't want to send it to a French bank account and then from a French bank account to the notaire if you can help it. It's better to go direct. It's also better to use a good currency broker, because you're going to get a much better rate of exchange by using a broker. We offer 3 different brokers on our website. Money Corp is one of them. And that way you're going to get the best rate of exchange with the least amount of commissions, or the difference in the spread, you know, the difference between the buy and the sell rate. Brian can even maybe add something to that.
Well, no, you've hit all the main aspects there of moving the currency in the right way.
Well, and the other thing is that when you do sell a property in France, okay, and the money comes to you in euros, you don't have to necessarily repatriate that money immediately. There's nothing that tells you that you have to move that money back to the US at that day at that rate of exchange. If you've got a French bank account, which you must have if you own property in France, then that money can sit in that French bank account for as long as you like, to be used for another property, for example, or whatever else you want to do with it, or until you get a better rate of exchange to repatriate it, right?
And that's a really good point. If, let's say a year out, you're going to be buying a new property, but it's sitting on the sideline for a year. Interest rates are starting to move up in Europe, to where expectations by most of the analysts would be that we would be able to get a 10-year at 4.5% on a bond. So we're no longer looking at these negative interest rates that we've had for such a long period of time, where bank on deposit was so horrendous, and that's going to get better and better by the month. So if you have a large sale amount, you want to keep it in euros, you don't want it in the bank, but you'd like it invested in euros in fixed income, we have an inverted yield curve. Adrian, you might have seen my newsletter, Jonathan, where
I talked about it.
Yeah,
Actually.
All we're comparing is a bird's legs knees being backwards and inverted, and that's what we have as an inverted yield curve. So short-term interest rates are higher than long-term interest rates. So it's a perfect place to keep euros, dollars, pounds.
I would also like to just add that we're only a couple minutes away from the traditional end of this webinar, which means we don't have time for Q&A. I'm very happy to extend this by 15 minutes if anyone else is okay with that, in order to answer some of the questions. Okay, you're okay with that, Jonathan?
Absolutely. Brian, as long as Brian's not drank too many bees knees, we'll be good to go.
I don't even have one bee's knees. I've got a cup of tea. I'm being properly British here.
There you go. So to finish up, just to give you, the obligatory self-promotion information, here are my details. We are Hadida Tax Advisors, hadtax.com. We are in France. We are in Switzerland. We are more than happy to help however we can. Again, we try and make your US tax and French taxes experience as easy as possible. We are all expats ourselves, so we know the joys of being a US expat, of being an expat coming abroad and having to deal with these multiple tax jurisdictions. So again, we try to help you as best we can. Hadida Tax Advisors. And let's touch on your Q&A. I can see Brian already looking for the hardest question in the Q&A to ask me. But go ahead, Brian. What do you got?
Well, Patty, are you running these, or do you want me to run these?
Up to you.
Well, Patty, why don't we go one and one, and we'll since it's International Ladies Day, well, I'll let you go first.
I do want to make a comment though. Some people are putting questions in the chat, and it would be easier if you kept them in the Q&A. But Brian, I'll start off. And we have a question from Kat that for the worldwide account reporting, do we need to include credit cards, debit cards, PayPal and term life insurance accounts?
Depends which country we're talking about, but generally the answer is yes on PayPal. I'm not certain on, no on credit cards, no on debit cards. Term life insurance depends which country and depends where we're looking. So I'll answer yes on PayPal, maybe on term life insurance is the best answer I can give y'all right now. Again, it depends on because it depends which country we're talking about.
Great.
In terms of estate planning, because the next question I see is on estate planning, that's outside the scope of this session. But Lori, if you're interested, let me know, shoot me, and I can point you towards an estate planner, because yeah, that's outside the scope of this session.
Pat has another good question, though.
We
Are they-
planned on doing an entire session just on
Yeah.
that, right, Adrian?
We are.
Well, no, it's a good question, because the tax you pay on a house purchase, which is a little over 5% on the notarial taxes and fees. The question is it deductible or creditable on your US tax return?
No.
That's one of the things that the treaty has overlooked.
Yeah, but no, there's no, it's not the tax. But that being, no, the answer is no. The long story short is
But it's
no.
like sales tax. Sales tax is, the same story. You're paying sales tax in France. You can't get a credit on the US side for the same,
Yeah,
right?
exactly. What we got next?
How is a U.S. defined benefit retirement income and investment income taxed for Americans living in France? We covered on that somewhat.
That's
But-
pension. It's a
Yeah.
pension. It's a pension income. So under the treaty, bee's knees for American retirees. You pay tax in America. You will not pay tax in France. Again, it's reported for rate purposes, but it is not taxed in France. You will not pay any French taxes on your U.S. pension income.
Okay, you want to go
Well,
next?
On a similar note about income, Jonathan,
Yes,
the
ma'am.
question is, what if you have rental properties inside an S corp that pays yourself a nominal salary, say 45K? Is that salary also exempt?
Yes and no, more yes and no, depends where you work. That's a great question, very, very heavy and very, very complicated from a French tax perspective, because it looks at where are you working. So in cases of someone, in this case where you have rental property in an S corp, and again, I'm not a big fan of rental properties in an S corp, but that's another story. The salary you pay yourself, we'd have to look at where you're doing the work and whether or not it's French sourced income or not. So the answer is, it depends. Because like every good tax answer, it depends, and it depends. But I would go with it could potentially be taxed in France. It really depends on where you're doing the work. And it depends on your facts and circumstances. So heavy question, and very factual to each case.
I'm loving the number of references to bee's knees in here. It means they paid close attention. And I always love New York City references. So the bee's knees means you don't pay state or city taxes if you live in New York City.
Well, the answer is,
Good question.
I read that one, and the answer is no, because if you live in New York City, you're paying New York City and state taxes. So
Exactly.
Again, you have to be breaking residence from the state, and state residency depends on a myriad of factors. It depends on each state, because each state has their own domicile rules or residency rules. But if you live in New York City, you're probably a New York State resident. Again, facts and circumstances, it depends on your case.
Could you be resident in two places?
Yeah, you could be, depending on your facts and circumstances. Again, we'd have to look at what your facts are and what your circumstances are. But yes, potentially you could be a resident in both countries. Again, if you're a resident in New York City, that means you're spending most of your time in the state. You may not wind up being a resident in France. Again, unfortunately, that kind of question is facts and circumstances. We'd have to look at your specific case. Considerations for dual citizens that we should think about. It doesn't change anything. If you're a dual citizen, the thing that I like to tell my clients who are dual citizens, from a US tax perspective, and listen to me very, very well, the US government considers you a US person first, a US person second, a US person third, fourth, fifth, sixth, seventh, eighth, ninth, 10th. They could care less if you're French from a US tax perspective. So never, ever, ever, especially dual citizens, forget that you're American. Because again, it's very easy for Bob Smith, French guy, to forget that he's also American when he goes to a French bank and the French bank tells him, hey, come invest in this nice little investment, sir. You are American, so never forget that. So that's the main consideration when it comes to dual citizens, is you're American. And that's all that matters for Uncle Sam.
Did you drop the A from that? Did you just say American?
Yeah, American.
American.
American. I'm going to be self-dealing here. Carolyn asks, if you're a U.S. citizen with investments being held and managed by Dunhill Financial based in the U.K., how are those funds treated by the U.S. and French tax authorities? So just because I'm here in the U.K. and we have a U.K. company and we deal with Americans here in the U.K., we also have a MiFID license in Europe, and we also have a U.S. license on the U.S. front. Whenever we're dealing with Americans, in France especially, we're keeping the investment vehicles in the States and we're going through the SEC company. So your investments are going to be fully in the United States. Therefore, you don't have to do that FBAR. Jonathan gets a nice clear 1099 and you have everything that's PFIC free, totally copacetic, nice and easy, so that you can move on to your bee's knees and enjoy your evening.
And from a French tax perspective, it's US sourced investments. So therefore, under the treaty, you don't have to pay French taxes on that income. Okay. The next one from Lori. This was a bit tricky, Lori. As a French resident, if I have to pay capital gains after selling my US house, will I have to pay additional taxes in France? Would it be better to sell my US house before becoming a French tax resident? And this is a tricky one, Lori. And the answer is yes. It generally is better to sell your house before becoming a French tax resident. Because from a French tax perspective, if you are a French tax resident, you are taxed on a worldwide basis, and the treaty does not apply in the same manner to the sale of real estate. So if you sell a house in the US, so I have a client, we actually all have a client, everyone on this call, we all work as a team for a client in the south of France. She's selling her house in San Francisco. That house in San Francisco has been held for X number of years. It's being taxed in America because she's got a nice gain, but it's also being taxed in France. Now, what happens is that France gives an actual credit for the taxes paid in America. So again, if you're paying tax in America, you may wind up not paying tax in France because you have enough credit. But if you don't, if it's your principal residence and under Section 121, which allows you to have $250,000 to $500,000 of exclusion on the U.S. taxes, you may wind up paying tax in France and not in America. So if there is a question, should I sell my house before coming to France? The answer is maybe. It's a good consideration to keep in mind, because once you're in France, it is taxable in France. Okay. What else you guys got?
Let's go to Hugh. Sorry.
Go ahead.
If I'm an American with solely U.S. income, resident in France, my estate is still taxable in France upon my death. Is that correct, assuming I don't have a living spouse? If the state where I vote but no longer reside in the U.S. also has an estate tax, is my estate also liable for that tax?
So Brian, this is you, right? This is you putting in your question from last week.
Well, it's actually written in here, but here's the beauty of it. We've kind of answered part of this, and it's all about defining what is residence for each state and each placement.
Yeah.
So the key is,
and basically from an estate tax perspective, if you're living in France, France will more likely to not come after your estate. And then we have to look, estate planning is a whole different kettle of fish. It's a whole other topic. As Brian was saying earlier, this is going to be something to be talked about much, much more at a later date. But basically, the answer, Hugh, is yes. More likely than not, your estate will be taxed in France. And then from a state perspective, again, facts and circumstances depends on where you're from and what state you're in.
every state defines residence a little bit differently.
Yes, sir.
Nevada seems to be the easiest. step
Yeah.
on our ground. Yeah. Your fun fact for the day, Jonathan.
Exactly. What else?
I see one I'd like to answer. It's the last question that came in. It's whether the cost of the purchase of the replacement house is subtracted from the capital gains of the sold house. That is a no.
No.
No rollovers. No.
Yeah, no rollovers. There's a question here. Are Roth IRAs subject to RMDs or not? Roth IRAs are not subject to RMDs. So that's just something to just take note of. Again, I saw that question because I scrolled down to the end.
Here's a good one that you talked about 529s a little bit. What would be your recommendation in the future for savings that help invest in our child's future? Examples are covered L's and 529 savings plans. There's a tax advantage in the US, but would distributions or gains be taxed in France?
I don't believe they would be. So no, distributions or gains would not be taxed in France because again, it's similar to the US investment or a pension fund. So a distribution from a 529 plan, I would treat it similar to an IRA. So no.
I'm gonna.
But on those, I do give a word of caution. Is again, if you live in France and your kids are in France, you know what makes them want to go to University of Wisconsin? What makes them want to go to NYU when they have great schools here in Europe? So that keep that in mind with when you invest in 529 plans in kids who live here. That kids who live here want to go to school here with their friends and may not be able to use the 529 money.
I'll add to that just a little bit. When it comes to 529s and covered L's, there's 529s are state-sponsored plans. So therefore, you naturally have to have residence in that state or an address that you can utilize in that state. Most expats are not resident back in the States in some way, unless grandma or grandpa fund that 529. So the contributions can be harder because of that state need.
I don't want to forget, I have a question for you based on the 8938 form.
Yes, ma'am.
It came up today. We have lots of owners in our fractional properties, okay? And the structure is such that they actually own shares in a US corporation, and the US nonprofit corporation owns the property itself.
Okay.
So we had a question from one of the owners if they have to file the 8938 form because it's foreign, the question is if the shares are in the US corporation, but the US corporation owns a French property, so do they have to file the 8938?
I don't believe so, Adrian, but I'd have to look at that. I'd have to look at the contract. I don't believe so, because again, it's a US, they have shares in a US corporation. They don't have a foreign bank account. They only own a piece of property. The 8938 doesn't report properties held in Europe. It looks at bank accounts, insurance accounts.
Right.
So I would say more likely than not, no. 99%.
Well, I didn't think so. Right, and I didn't think so either, but it could be from the French tax perspective, might be different, but it wouldn't matter, would it?
No. Now there's two questions here, Agent, I do want to touch on. Are épargne and retraite en entreprise accounts considered a PFIC? And is life insurance required for a French mortgage considered a PFIC? Okay, these two go hand in hand. Here are the answers. It's not the plan d'épargne de retraite that is the PFIC. It's not the life insurance that's the PFIC. It's the underlying assets that you hold within them that may be PFIC. So again, if you have a plan d'épargne de retraite d'entreprise and your entreprise invests in l'entreprise, so if you're working for Total, I don't know, but let's say you work for Total and Total gives you total stock in their plan d'épargne d'entreprise, that's not a PFIC. But if they give you an investment in a wide-ranging mutual fund, that is a PFIC. Okay. Similarly, is an life insurance vehicle required for French mortgage considered a PFIC? It depends on what is invested in that life insurance. So again, it's not l'habit ne fait pas le moine. Il faut regarder sous l'habit. You have to look underneath the hood to see what's actually going on in order to see if it really is a PFIC. So yeah, 9 times out of 10, yeah, they probably are PFICs, but you have to look underneath the hood to see what's going on before we can give an answer. Because again, the most important thing with taxes, yeah, it's the facts and circumstances. So again, if you want to change your tax, you have to change your facts. We have to look at your facts, and it's all about your facts. Okay, so that's why it's so important to just speak to someone and go through, case by case, because no personal question can be answered with just off the cuff. So just keep note of that.
So let me just make note that it's now beyond 8:15. I think maybe you want to just wrap this up, and is there anything you want to say in the end? And then what's your idea about answering some of these other questions? You think we'll just try to do this on a individual basis?
We'll try to do this on an individual basis. If y'all send me an email to team@hadtax.com, so team@hadtax.com, me and my team would be happy to get your questions and try and answer them as best as we can. Patty or Hugo will give us a list of questions, and I think there'll be emails there. We'll try our best to come back. But again, shoot us an email at team@hadtax.com, and someone in the team will respond as soon as possible. The only other thing is basically anybody who's in Paris, come to Adrian's après-midi.
Yes, Tuesday, 3 to 5 p.m. It's free. It's at Le Café de la Mairie at the corner of Rue des Archives and Rue de Bretagne. Jonathan's going to be there. We'll have 2 hours where he can answer plenty of questions. So definitely, I'm looking forward to having you there. That's for sure. It's going to be a lot of fun.
Adrian, every time I get to come to go to Paris with you, it's magnificent. So I'm truly excited for it. But again, Tuesday 3 to 5, we are going to be talking about U.S. taxes and French taxes. We're going to go into a little bit more detail on each because we've got a little bit more time where we can spread our wings and let them fly. But again, 3 to 5, Paris, magnificent time. Adrian's not going to buy for everybody, but you can buy a drink and we can all have fun. We can all have a rousing good time. But again,
absolutely. And Patty put a link in the chat so that there's a link to our site with all the information. Okay. And Jonathan, you are absolutely splendid, hilarious, wonderful, amazing. I can't thank you enough. Brian, thank you. Patty and everybody on the team, this has been fabulous. And don't forget, the next one of these webinars is June 7th, 7 p.m. France time. And there'll be more information about that on the site. This is recorded. You'll be able to listen to it again. You'll be able to share it with your friends. And I hope everybody has a wonderful rest of day.